Think that the MSCI World or S&P 500 are the go-to ETFs? Actually, there are better options, which we will explore in this video. If you have any questions regarding the topic of this video or finance in general, drop them in the comments. First, let's start by saying that it is a scientific consensus that most private investors should use a globally low-cost diversified ETF on the world economy. If you have interested in the specifics of that, you can check out my investing guide, part 1 video. Also if you want to find a more niche, specific ETF, and I think many of you probably think of investing in the MSCI World or S&P 500. Anyway, you could also use the same criteria. But again, I don't think it makes sense for most private investors to place these specific country or sector bets, but you do you. To find ETFs, ideally we want to use an ETF filter. This will give us the information which ETFs are even available for us to buy in the first place, and ideally also show at which brokers we can buy these ETFs for the lowest fee. For European investors, I think the best known ETF filter will be justETF. But I was really surprised that I didn't find a good free ETF filter alternative for US investors, even after researching for quite a while, looking on Reddit and even asking ChatGPT. If you don't have access to a good ETF filter, just search the name of specific indices or ETF names in the broker of your choice or bank. But if you have recommendations for ETF filters for US investors, please let me know in the comments. And if you are a viewer from another country or region, let me know as well, so I can try to include more specific information for your country in the long run. Also scientific basis for my information regarding ETF selection, I draw from Gerd Kommer's Souverän Investieren, 6th edition from 2025. The scientific passive investing Bible for Germans. And for ETF selection specifically, I looked at the chapter 10.4, choosing the right ETF for your world portfolio. If you can read German, I highly recommend you to check out the book. When searching ETFs on justETF and you are using a VPN, consider putting it on the country that is relevant to you, or put the VPN off. I saw that a Reddit user pointed out that, at least for him, it seemed like justETF was showing him different ETF selections depending on his chosen region. In my VPN testing, just now with Germany, Switzerland, and the UK, I could not replicate this. But well, it's something to keep in mind, especially if the ETF selection seems a little bit off. justETF selection step by step. First, let's type in www.justetf.com. Let's click on search and find ETFs. Nowadays, you can also buy ETFs for gold, cryptocurrencies, money markets, etc. But today we are interested in ETFs that invest into the world economy / stocks. Therefore, we select under equity and region world. You can also select ETFs on specific regions, but again, for most private investors, science tells us that we should not get into specific region or sector bets. Then under sector, you also choose no sector. For equity strategy, there is a scientific debate if factor or multi-factor investing makes sense for rational passive private investors. My impression right now is that I would probably rather avoid it, but in general, if you don't know what it is all about, I don't think you should select it. But if you are willing to invest some time into your passive investing approach, you can definitely look into that topic further. And if you are interested for me to cover this topic in a future video, please let me know in the comments as well. Similar goes for selecting social / environmental to find ETFs with ESG rating, for example, or that focus on climate change topics. In theory, this sounds like a great option, but what actually counts as ESG or environmentally friendly, it can depend on the criteria that the fund uses. and this doesn't necessarily have to align with what you put into that category. Also, I think, at least for me, it's not clear right now if investing as a small private investor with ESG funds really supports these selected ESG criteria. Or we can just end up paying extra for environmental marketing and get lower diversification. Again, if you're interested in this kind of funds, I can encourage you to do more research in them, or let me know if you're interested on another video from me on that topic. Same goes for selecting only sustainable funds. So for now, I would select no equity strategy and no theme, and not select only sustainable funds. For each of the funds, Kommer writes in his chapter that it is not really an important general selection criteria, but it can be looked in specific cases, especially for younger ETFs that will in general have a lower volume compared to similar ETFs that are older. But yeah, as an own comment, at least for me, very young ETFs that are under 1, 2, maybe 3 years, I would definitely do additional research, especially if they, have lower fund volume. And also if this fund tries a new replication method. In this case, I think it can make a lot of sense just to wait a little bit longer to see if the method and fund will actually be successful in the long run. If a fund, worst case scenario, you invest in closes, that is still not the end of the world, but it will probably mean additional bureaucracy for you and paying more taxes, which most private investors will want to avoid. Yeah, accumulating funds automatically reinvest the dividends. Therefore, I think this makes them the preferred choice for many private investors that don't want to keep an eye on when they should reinvest dividends themselves. But then, of course, distributing funds pay them out. But for US investors, for example, they don't really have a choice, because with their legal framework, most of their available funds are distributing funds. For European investors, accumulating funds will be more tax efficient in many countries. As you save the tax, you would have otherwise had to pay on the dividend payout. But in certain countries like Germany, etc., they do have extra tax rules that change which ETF version could be more tax efficient, or at least make it less clear. So just in case, always do some additional research what applies in your jurisdiction. And again, if you want more specific information on certain countries, let me know in the comics. But because oftentimes there's less manual work and more tax efficiency for many investors, at least for now, I will select accumulating. And then for fund size, Kommer writes that smaller ETFs will probably have a higher risk of fund closure. Because then it means that they're probably not profitable enough to keep going in the long run. But yeah, this kind of risk is hard to calculate exactly, and still for most ETFs should be relatively small. But he has some more specific guidelines. He thinks, a fund under 50 million might not survive in the long run. But he would not apply this generally to funds that are younger than 3 to 4 years, because, as we covered before, funds that are younger, tend to have lower fund sizes in general. For me, I wonder a little bit if, his opinion might be a little bit influenced by him starting his own fund in 2023. Because if the fund is young and still has a low fund size, then, I don't think it can hurt to wait 1, 2, 3 more years longer to see if the fund will reach this critical mass over 15 million. And also according to justETF, the fund from Gerd Kommer already has over 700 million euros invested. And then also justETF makes the point that larger ETFs are more likely to be more profitable and therefore also in the long run seems like more likely to reduce their costs and less likely to be closed. Yeah, and also with larger ETFs, they will probably have a higher trading volume as well, making it again more likely to get better prices when you want to buy or sell them. So if all else is equal, it does seem, at least in the financial world, that bigger is better. And for justETF, they only show the option to select larger than 100 million or 500 million ETFs. So yeah, in this case, even the comma says we should look to have them at least larger fund size than 15 million. We will just select 100 million in our case. Let's talk about replication methods. Physical replication means the ETF just buys all the stocks that are included in the index they are following, or at least they try to. That with ETFs, they try to invest into the world economy. You can imagine that it can or could get quite expensive to buy stocks from very small companies that might not have the same trading liquidity as big stocks like Nvidia, Apple, or Amazon. Optimized sampling combats this problem. By having not to buy, they don't have to buy literally all the stocks. And with some statistical finance wizardry, they buy just a sample of the companies their index tries to track, while still tracking their chosen index very closely. And then with swap-based ETFs, they use even more finance wizardry, as they are not actually investing into the underlying assets of their chosen benchmark, but they do deals with banks, etc., to try to guarantee the return of the index. Yeah, for European investors, also these swap ETFs, they could be more tax efficient, as the ETFs that track the world, of course, will have very large holdings in the US. And consequently, they will have to pay a lot of taxes on the dividends of the American companies inside of America. But for swap-based ETFs, um, like they have the advantage to not have to pay these taxes. But on the other hand, even though it is considered very small, they do have, because they do this kind of deals with the banks, like a counterparty risk. Well, for example, if the bank that was supposed to guarantee the returns of the tracked index turns out not to be able to do so. And then we also see one hybrid world ETF right now. And this one is the new one from Scalable. Why is it called hybrid? Well, they use swap-based tracking, I think, for the US and China. Like for the US to, cut down on the taxes. And for China, it can be quite difficult to actually, buy all the stock you would like to buy in China. And then they use physical sampling for the rest of the world. Yeah, this definitely seems like an interesting approach and something that might be very promising. So they try to combine both advantages of both like physical and swap-based replication methods. But at least for me, I would first wait and see if they can actually deliver on their marketing promise of systematic outperformance. Also, the ETF was just set up in 2024. But yes, definitely again something you can look into further if you are interested. Now let's talk about providers. As you can see, all the ETFs in our selection, they have this UCITS in their name. And this stands for Undertakings for Collective Investment and Transferable Securities. Yeah, these are basically the audited real ETFs under European law. And I would advise all European investors to make sure to only invest in UCITS ETFs. As finance products, like ETF is not really a secured name. So there can also be finance products that do not really adhere to what we would traditionally think of ETFs. For example, oftentimes we think of ETFs as passive investments, but nowadays there are also ETFs that use active trading strategies. So only advanced investors that really know what they are doing should consider investing into a non-UCITS DIS ETF. And as this is specific to European investors, of course, this is not relevant to US investors. And also for specific providers, Kommer tells us that he doesn't really think that it really matters that much as long as we are, looking into UCITS ETFs. And again, for the index family, he also thinks it doesn't really matter. But of course, you have to pay attention if you try to mix and match ETFs from different providers. For example, very popular strategy is to combine developing and developed markets. So let's say an MSCI World and MSCI Emerging Markets. And we also have another provider called FTSE. So if I take the developed world from MSCI and the other part from FTSE, for them, they do classify different countries as developed versus developing. So if you try to mix them, it could be the case that you're actually missing out on like certain countries in general. And with that having like lower diversification than you really want to. And also for European investors, if you are using an ETF with physical replication, Ireland will be a little bit more tax efficient, as Ireland has the most tax deals with the US. But then again, for example, the new scalable ETF, he would not really benefit that much, or wouldn't really benefit from the US deals, and maybe that's also one of the reasons why he is set up in Luxembourg. About currency hedges. For currency hedge, we can safely select unhedged, I would say. Because with the worldwide ETF, we are already exposed to a lot of different international companies using all sorts of different currencies anyway. And therefore, for private investors, paying a higher fee for currency hedging, doesn't really make sense. ETF listing. If you don't have a specific preference for an stock exchange, we can just click on Show All Listings. And depending on which broker you want to use later, maybe you only have certain stocks available through the broker of your choice, and then of course it can make sense to narrow it down. In our example, now we are left with 31 ETFs. And of course, a similar tool for the US, would show a different selection for ETFs. They wouldn't have the UCITS name, and in general, the US, similar US funds would have a lower TER, and this is total expense ratio. So now what? In our selection right now, we still, for example, have MSCI World ETFs left. While it sounds like with the MSCI World, you would invest into the world economy, you actually only invest into the developed world countries. The counterpart of the MSCI World would be the MSCI Emerging Markets, together creating the MSCI All Country World Index. He's the pendant to the FTSE All World, which consists of the FTSE Developed Markets and the FTSE Emerging Markets. And according to justETF, the MSCI All Country World covers roughly 85% of shares worldwide, and the FTSE All World around 90 to 95% of the investable market capitalization. But we can go even a step further with the MSCI All Country World EMI. And the EMI stands for, I think, investable market. This EMI index, he also includes the MSCI World Small Cap, so the small caps from developed markets, and also the MSCI Emerging Markets Small Cap, so the small caps were from the emerging markets. But of course, if we get into this big indices like 85, 90, 95, 99%, we still expect them to all perform very similar. Already the MSCI World will perform similar to the MSCI All Country World, even though, of course, this is like a comparison where we would be able to see like larger differences. And then again, the MSCI All Country World would be very similar to the FTSE All World. And then the FTSE All World we can expect to be very, very similar to the MSCI All Country World EMI. And if you choose, you could also, like for the worldwide ETFs to consider, yeah, keep in mind the offerings from Scalable Capital. And also, if you're in Europe or Germany, you could also consider the new ETF from Gerd Kommer. Um, yeah. And well, for this criteria, if you also want to select like ESG or multi-factor investing criteria, your end selection you would have to deal with would look different. And yes, for Comma, he started his own ETF and he uses like a different model for market capitalization on countries and multi-factor investing as well. But yeah, this is something, if you're interested, do more research on that. So now we have all these ETFs. So how do we choose which one we should actually take? Yeah, for Kommer, in this chapter, he actually recommends to, and it sounds logical, to, if everything else is equal, just select the ETF with the lowest cost or TER. But I'm actually not sure if I can fully agree with him on that. Again, it might not be very intuitive, but the total expense ratio actually does not include all expenses. In an article from justETF, this is explained. So additional costs that are not included in the total expense ratio are the rebalancing costs, swap spread, and security lendings, for example. Yeah, which can lead to the ETF to deviate further from its initial target besides just the TER. And yeah, oftentimes the ETF will lag behind the index return, as the index, of course, does not have to pay the internal costs that are associated with running a real ETF. But again, surprisingly, sometimes ETFs are performing better than their chosen benchmark. You might wonder, "Oh, how is that even possible?" We try to like track this, hypothetical index, and we have this ETF with additional costs. So how could we actually perform better? Well, by law, most UCITS ETF mostly just try to track the indices, and they are not allowed to leverage or do a lot of deals on the side. But they can earn additional income with, for example, security lending. And also, ETFs need to be rebalanced from time to time. And in some cases, the ETF can get lucky, and the part that was overexposed, well, compared to like the index he tries to follow, he might perform better before the rebalancing takes place. Yeah, so the difference between index returns and ETF return is the tracking difference, which sometimes can be positive as well. Well, in this case, why not just choose the ETF with the best tracking difference, you might ask? Well, we can look at the historical tracking differences of ETFs, but we run into the same problem we have when trying to pick individual stocks. Past returns don't necessarily guarantee future performance. And keep in mind, we are investing in ETFs in the first place because the stock market is just too inefficient nowadays. And yeah, we can assume like the stocks to follow a random walk. And if ETFs are just repackaged stocks, it would only seem logical that ETFs would follow a random walk as well. Therefore, diversification in the sense of investing into different ETFs from different providers could make sense. But of course, investing into a lot of different ETFs just for this tiny marginal diversification of this tracking, um, yeah, difference, of course, you have to offset by the additional management complexity. And at least I think in the book from Kommer, he doesn't really talk about if ETFs also have a random walk or not, but at least this seems logical to me. So if you have interest in the topic, we can also talk about that further. And also, I don't know anymore exactly where Kommer said it, but I think that, well, investing into multiple different ETFs, even though if they track the same index, it can be a hedge against fund closures, for example. But he would only start thinking about this if you are investing more than 500,000 into ETFs. Because then we'll be really talking about like more advanced things to consider, and this additional bureaucracy really only makes sense if you're talking about a big portfolio where this makes sense. Well, anyway, if we are a rational passive investor, we should choose the ETF tracking the largest index, unless of course the cost of this additional diversification outweighs its benefits. And to my knowledge, there are no ETFs right now that track an index that covers more of the world than the MSCI All Country World EMI. Therefore, we can directly select it under the matching indices. And the only accumulating ETF tracking this index right now anyway will be the Spider MSCI All Country World EMI. And it has a TARE of 0.17%. So not really that much different to the costs of other MSCI All Country Worlds or the FTSE All World indices. For example, the FTSE All World accumulating has a TARE of 0.19% and the Spider MSCI All Country World of 0.12. And again, the TARE does not necessarily mean better tracking difference. And I would tend to recommend rational passive private investors to just go for the Spider MSCI All Country World EMI. But also Kommer writes that ETFs using less well-known index providers could also have a cost benefit. But again, for this, I'm not sure if I can 100% agree on that, because if you think of the stock market to be really that efficient, that the stocks already are following a random walk theory, I could also imagine the stock market being clever enough to pick up on that as well. But yeah, this is something I could look into further to do further research as well. And I could also understand investors if they are thinking that they can save some costs by choosing an MSCI All Country World, for example, for the lower cost running cost, or choosing the FTSE All World because of the strong brand association and reputation of FTSE, and also like the reputation for them to try to lower the fund costs if possible. Even though for the FTSE brand, like I think recently they had like a little bit of drama where they lowered the costs of the funds in the US. But for example, I don't think in Europe and not in the UK, where some investors from the UK and Europe felt a little bit left out by that. And of course, you could also consider synthetic ETFs for trying to save the taxes in the US. And I also don't really think that, buying an MSCI World makes a sense from a pure passive investing approach standpoint. But in practicality, it still will perform, of course, similar to the MSCI All Country World, as the MSCI World, I think, makes up around like 70% of the MSCI All Country World index anyway. And again, if your broker only has the option for the MSCI World, or you already started investing into an ETF and you don't really want to have the complexity of starting to invest into another ETF, then don't sweat it. And just invest in what you have. As long as you're already investing, that's much better than doing nothing with your money. But at the same time, of course, if you haven't started yet or you are considering like to switch things up, then of course, consider starting to invest into the the broadest ETF you have you can choose to invest in at your broker. And again, remember that the only free lunch at the stock market is diversification. So while discussing all these criteria now seems a little overkill, if we could just choose the MSCI or country EMI from the get-go, I think this already lays a solid foundation. The ETF space is not really evolving as rapidly as, let's say, the AI space, but in that regard, it really is a tortoise. But that doesn't mean that things don't change from time to time. And even if you want to or end up choosing another ETF or your ETF selection in another country looks completely different, I still think the topics and criteria we discussed today can be a good foundation for you to choose your ETF, even if you don't have access to the very specific ETFs we looked at today.